we're cautious on credit markets. Part of it's Fed related, but there's a bigger story behind it. We think a bear market in credit has started. It started when investment grade credit hit the tights this past February. It's been hitting global credit markets this year one by one. The high yield market has finally cracked. That took longer to roll over than we would have thought. And even the leveraged loan market has finally rolled over the last couple weeks. A big point that we're trying to drive home as a part of our 2000 outlook is that a turn in the credit cycle is not just some specific point in time. It's a long, slow process that starts when growth is strong and when policy gets tight. We think the process has started, and as it continues to evolve, you're going to continue sort of hitting the weak links along the way. Or said another way, the sort of excesses that really built up over the course of this long credit bull market start coming to the surface.
Yeah, we're in that boat now, aren't we? How serious is that going to be? I thought that we all agreed that the Bernanke-Yellen Fed had orchestrated a rescue of the entire global economy and that it was going to be trouble-free. Do we need to revisit that? Should they have taken a victory lap, or is there some real day of reckoning to come from all the excess liquidity that went to places it shouldn't have gone?
Yeah, I mean, I don't know that I would phrase it that extreme, but yes, if you look at what monetary policy has done in this cycle, it was hugely supportive of credit markets for many, many years. So the Fed took all this duration out of markets, and the flows, the money had to go somewhere, and it went into credit markets, and that incentivized companies to issue debt to buy back their stock for M&A and for other purposes, and they did that. And so now we're starting to see the process in reverse, the Fed hiking rates while shrinking the balance sheet at the same time. And naturally, you should expect to some extent that has the opposite impact. It's weakened the flows into credit markets, and it was always something we thought investors were underestimating as we headed into 2018. We think the story for 2019 starts to become a little bit less so about just this sort of tightening in liquidity conditions and morphs into slowing growth expectations, weakening earnings growth. And as that happens, some of the fundamental pressures continue to spread out, and we continue to progress along this slow turn in the credit cycle.
So the latest equity market volatility that we've been dealing with, which seems to either portend that the Fed was going too fast, or that the economy was near late cycle, or that the recovery was coming to an end. Is any of that overstated, Adam? I mean, has the path of the Fed changed for next year based on the last 6 weeks of market volatility combined with growth expectations coming down? Or is it the same it was? Are we overstating that? They still going up 3 next year?
So our house view is that they're going to hike in December next week. They will hike again in March, in June, and then they will pause. Clearly the market is very, very focused on exactly when and if the Fed is going to pause. I think to some extent we might be focused on the wrong thing, or maybe too focused on exactly when they pause. If you think about in past cycles, the bulk of the spread widening actually happens from the point when the Fed is done hiking until the point when we are deep in a rate cutting cycle, because that is when the economy is really weakening. So, if the Fed pauses a little bit sooner because of this tightening of financial conditions, but hypothetically, let's say that pause happens as growth is weakening, that's not necessarily something that's going to be that bullish in my view for markets or for credit.
All right. So in terms of the economic cycle, just that you're basing all of this on, what do you think for next year in terms of GDP? Can we muster 2.5? I mean, that'd be slower than this last year, right?
We have growth slowing from about 3. Our economists, our chief U.S. economist, Ellen Zettner, has growth slowing from around a little above 3% in 2018 down to 1.7 in 2019. And in fact, the low print is the third quarter of 2019 of just 1%. And even more importantly, our equity strategist Mike Wilson has talked about the likelihood for a modest earnings recession next year. So call it a quarter or two of modest negative year-over-year earnings growth is reasonably high. So again, an environment where liquidity conditions keep getting squeezed for now, you get this fairly meaningful slowdown in growth. We have earnings growth, which starts to stall. That's a challenging environment for credit markets. I mean, we've had a couple mini growth scares in this cycle in 2011 and in 2016, and credit markets traded at recession-like valuations in both of those.
Wow. Those are horrible numbers. I wish I hadn't even had you on today, Adam. What did you say? 1.7 next year? What's Ellen?
It's really low.
From what? From what? From what? From China? From trade? From Keynes? You think all this tax stuff was Keynesian and it just dries up?
Yeah, I mean, part of it's the fiscal stimulus starting to fade. Part of it's the tightening in financial conditions. Part of it's, weakening business investment. Part of it's, Fed rate hikes already impacting the interest rate sensitive parts of this economy. I mean, I guess, look, I don't want to be all bad news. So what I would tell you, a silver lining, is that sentiment is much more negative in credit.
Did Ellen predict 3% for this year, or was she one of the, no, we can't get above 2 ever?
No, I don't think she was. I don't know if it was quite as high as 3%, but
Okay.
in that direction.